Welcome to this explainer. Look, if you've been watching the markets lately, you know there is a ton of noise out there. Everyone's got an opinion, but today we're cutting straight through that noise. We're going to unpack Standard Chartered's massive 2026 financial forecast to see if this current market we're in is built on solid ground or if it's literally just thin air. We're looking straight at the data to build a real roadmap for your portfolio. So let's dive right in. Right off the bat, looking at this AI-driven market, the elephant in the room is glaringly obvious. I mean, everybody is terrified that this is a massive bubble just waiting to pop. We see the crazy valuations, we read the headlines, and obviously, we remember history. It is completely natural to look up at these high-flying tech stocks and wonder, are we just blowing financial bubbles here that are inevitably going to burst? Well, to demystify this whole outlook, here's our agenda. Number 1, the AI bubble question. Number 2, the global equity engines. 3, the income shift. 4, chasing glitter and hedges. 5, the 4 bubble bursters. And finally, number 6, your 2026 playbook. Okay, starting with section 1, the AI bubble question. Let's evaluate this boom in risky assets. So, contrasting today's reality with the ghosts of markets past actually reveals a really critical distinction. Yes, valuations are undeniably high today, but the Standard Chartered report points out that we completely lack that dangerous embedded systemic leverage that basically blew up the world during the 2008 global financial crisis. And if you compare today to the late 90s dot-com bubble, the investments being made right now are actually much lower relative to the overall size of the economy. Plus, and this is huge, the companies driving this boom are wildly profitable. These aren't just speculative startups hoping for a click. So, the takeaway? While prices might be inflating, we aren't at bubble-bursting proportions just yet. In fact, the authors expect risky assets to actually thrive and outperform as we head into 2026. Moving right along to Section 2, the global equity engines. Exactly where is all this growth happening? Standard Chartered strategically favors an overweight stance on global equities, but they aren't just throwing money at a wall to see what sticks. The data pinpoints 3 specific engines of growth: the United States, India, and China. The U.S. is a powerhouse right now, driven by strong AI earnings and easing monetary policies. But check out the bottom of that table. They're actually underweight on the UK, Europe, and Japan. Why? Well, they're citing weak growth, stretched valuations, and various currency and geopolitical risks. Now, zooming in specifically on Asia, this is where the diversification strategy gets really interesting. India is offering premium growth. We are talking an expected 12-month forward earnings per share growth of a massive 15.5%. That's supported by high return on equity and solid policy reforms. Meanwhile, China is a slightly different play. They're offering incredibly attractive valuations. Even with a slightly cooler economy, China's EPS growth is still estimated at a very solid 10.5%, pushed along by policy stimulus and a huge push for tech self-reliance. Holding both of these markets alongside the U.S. makes them fantastic diversifiers. That way, you're not just crossing your fingers and holding a single U.S.-only tech basket. That brings us to Section 3, the income shift, seeking yield in emerging markets. Since we definitely want to avoid putting all our eggs in one equity basket, let's pivot over to the income side of things. In what might feel like a counterintuitive shift, the forecast strongly prefers emerging market bonds over developed market bonds. Now, you might be wondering, why is that? Well, developed market bonds right now are plagued by incredibly tight credit spreads. That essentially means they're pretty expensive relative to the low yield they're actually offering you. But emerging market bonds? They are currently offering very attractive nominal yields of around 6%. And not only that, these developing nations are showing much better fiscal discipline than we've seen in the past. When you combine that with the expected boost from global rate cuts, EM bonds start looking like a really fantastic source of steady income. Section 4, chasing glitter and hedges. Let's look at defensive plays as the US dollar weakens. To further protect your portfolio against any wild market volatility, we absolutely have to talk about currencies. The forecast points directly to a weakening US dollar in 2026. As the Federal Reserve pivots and cuts rates to try and support a cooling job market, the US dollar is going to naturally lose its yield advantage compared to other major currencies. And historically speaking, when the dollar weakens, it acts as a massive tailwind for non-US equities, commodities, and those emerging market assets we literally just talked about. It forces investors to go out and look for alternative stores of value. And well, that brings us to the ultimate classic store of value, gold. According to a companion report from UBS's Chief Investment Office, gold could skyrocket to a staggering $5,000 an ounce by mid-2026. Let that number sink in. It acts as a highly critical portfolio hedge against geopolitical shocks and falling real yields. UBS even notes that if global tensions escalate further, we could be looking at a push toward $5,400 an ounce. So, blending all of this theory into practice, what does it look like? A foundation portfolio for a balanced risk profile uses equities at about 54% as your primary growth engine. You use bonds at 38% for that reliable income, and then you maintain a strategic, glittering sliver of gold, right around 6%, just to cushion any downside. That leaves just a tiny 2% in cash. It's a structural setup specifically designed to let you participate in all this market upside while insulating you from unexpected shocks. Which leads us perfectly into Section 5, the 4 bubble bursters. What are the actual threats to this optimistic 2026 outlook? Look, no financial forecast is complete without a healthy dose of reality. Standard Chartered explicitly highlights 4 specific threats you need to have on your radar. Number 1, AI falling short of these sky-high expectations. If the earnings disappoint, or if these tech megacaps start borrowing way too heavily to fund their AI dreams, the market is going to punish them. Number 2, stubborn, unexpected inflation spikes that force the Fed to freeze their rate cuts. 3, a contagious credit event. Think of a sudden corporate failure that triggers a domino effect of panic and systemic default fears across the board. And number 4, an unexpectedly hawkish Bank of Japan. Japan provides a huge amount of global liquidity. If they suddenly hike rates sharply, it would send a massive shockwave straight through global markets. Finally, Section 6, your 2026 playbook. Let's talk about managing risk drift and, more importantly, your emotions. Knowing the growth engines and the threats is great, but what's your actual playbook? Honestly, the biggest danger to your wealth in 2026 isn't the market at all, it's your own psychology. You have to be hyper-aware of something called risk drift. This is the incredibly common tendency for investors to increase the risk in their portfolios during the good times. Sometimes it's passive. Your winning tech stocks naturally inflate until they make up a scary percentage of your entire portfolio. Other times it's active. You get caught up in the hype and start chasing insane returns. The problem is you usually only realize you've drifted too far out to sea when the storm hits, and those severe losses reveal that your actual tolerance for risk was way, way lower. Steve Bryce, the Global Chief Investment Officer at Standard Chartered, hit the nail on the head here. He advises that if you're fully invested right now, you need to stress test your portfolio against past crises. Literally ask yourself, how would my current setup have handled the crash between 2003 or 2007 and 2009? If looking at those hypothetical losses makes your stomach drop, do not increase your risk exposure right now. Instead, you need to use diversification to bring your portfolio to what he calls a sleep well level. So, as we look ahead to 2026, the data strongly suggests this market still has room to run. It's powered by AI, solid earnings across the US and Asia, and favorable rate cuts. But the ultimate question you really need to ask yourself, and probably your financial advisor, is this. Is your current strategy built on pure, unhedged optimism? Or are you truly diversified enough across global equities, emerging market income, and gold to actually sleep well at night? Are you just along for the ride, or are you genuinely prepared for whatever the market throws your way next?